Today I'm going to talk about how the Fed raising interest rates and inflation is going to shake up the housing market for buyers, renters, and sellers. First up, homeowners. I'm going to give you a number, $27.8 trillion. That's the amount of homeowner equity that people have today. Just to give you some perspective, the US GDP in 2021 was $23.1 trillion. For those of us that don't know, equity is the difference between the amount owed and what you could sell it for today. It's a great tool for people to use for home renovations, to pay for their kids' schools, and for vacations. So we're going to see a big wave of homeowners rushing in to tap into their equity. Well, that's one of the biggest conundrums homeowners have today. Well, it's getting more expensive to tap into that equity. And that's what the Fed's trying to do. By raising interest rates, they're trying to make it more expensive for homeowners to tap into that equity and cool off the economy. Rates right now are about 6%. At the start of the year, they were only about 3%. That means fewer people can qualify for a mortgage. Eric Finnegan, director of Johnsburn Real Estate Consulting, is a data guy, and he's keeping track of who can afford mortgages in the United States. It's a rough calculation based off of income, average debt across American household, and current interest rates. That data actually hasn't been too interesting until this month. So the last few weeks, the Feds have raised the interest rate again. That means that 18 million fewer households can now afford that same $400,000 property that they could have bought at the beginning of the year. That's a massive 36% reduction in the amount of buyers that can buy that same property. That means a lot of buyers have had to put their dream of owning a house on hold. So what are all these buyers doing? They're renting. So that takes us to our next big number, 15.3%. That's the amount on average that rents have increased across the United States just this year. And in some markets it's even higher. It's 20% in San Diego, 28% in Miami. According to Chris Salvanetti, who's an economist at Apartment List, he said that this year is unprecedented in the amount that rents have gone up. On average, rents only usually go up 2 to 3% a year. Prior to the pandemic, in 2017 to 2019, rents only went up 2 to 3% per year. That means that this year, rents went up 5 times that. There's a supply-demand issue here that's been playing out for a while. There's just not enough supply right now for the demand out there. In fact, according to the National Association of Realtors, some markets are actually seeing multiple offers on rental units right now. Demand has spiked in the past year and a half, and on top of that, we have raising interest rates, which means all those buyers that wanted to buy before are now renting, compounding an already complex issue. So some people are worried that the Fed raising interest rates may cause a recession, and if that does happen, it would definitely cause some downward pressure on rental prices. But supply and demand metrics right now are so out of whack, it's definitely going to take some time for it to recover. But actually, if interest rates remain high, it actually causes upward pressure on rental prices because it's more expensive to build homes. So what does this all mean for you? Well, it depends. Are you looking to buy or sell? Depends what micro market you're looking at. What are your long-term goals? If you have questions about how this is going to affect you and your plans, give me a call. I'll give you a free consultation. Let me know if you found this helpful and make a comment below. And don't forget to hit that like and subscribe button.